Welcome to the Westside Investors Network, WIN, your community of investing knowledge for growth. This is the Real Estate Professionals Investing Podcast for real estate professionals by real estate professionals. This show is focused on the next step in your career, investing. Thank you for listening. And please, if you like our content, rate us on your podcast provider. Just a quick disclaimer, the views and opinions expressed in this podcast are for educational purposes only and should not be construed as an offer to buy or sell any shares or securities, make or consider any investments, or take any other action.
Okay, well, here we go. This is the fourth part in our four-part series. We started with underwriting and acquisition, and then stabilizing, or the value add plan, and then stabilized, or basically continuing operations. And now we are into disposition.
Yeah.
So selling the asset.
The whole goal of the project, right?
I mean, is it the whole? Sometimes
you
you keep them forever.
Hey, sometimes it's the journey that's important, Chris, you know?
The journey, it's a lot about the journey and enjoying it.
Yeah. Got to remember that. Enjoy it. But yes, disposition is the point at when you may think of selling, or you may, want to keep the property. But jumping into it, like, how do we know we get to that point? And I actually haven't had a chance to see this part of the process, that Southwest 68th deal that we talked about previously in another podcast was already sold by the time I had joined the company. So how do we get to this point? Is it investor related, market related, timing related?
I mean, there are many, I guess, triggers, or many, I guess, situations where you would want to sell the asset. I would say for us, timing has kind of been a focus of ours. We have advertised a 3 to 5 year hold period for a few of our deals, and we want to try and meet that. But it's also very difficult in this current market with the way that prices are and just overall sentiment in the multifamily market. It's making it really tough to sell. Like, we've been trying to dispose 4633 Southwest Huber for 3 years now, and we're still in the disposition phase on that asset. And like, our value add plan is complete, and it's stabilized, and essentially we're just waiting for the market. The market, if we think of the graph, the market was up here. We bought Southwest Huber right here, and then it dipped, and I would say we're probably about at the spot where we bought it. But fortunately, we got it at a decent price, and we added value to it, so it's worth more. But, we want to be able to hit our returns for our investors, and the asset is still cash flowing. So we're just kind of waiting for the market to meet us at our sale price.
Yeah.
And so that kind of leads into another, I guess, strategy for disposing of assets. And that is just setting a sale price and letting everyone know what that sale price is, and then selling it when you hit that sale price. I've heard that that is a, phenomenal way to transact, and, it keeps the transaction flow, as long as your exit numbers aren't ridiculous, you potentially can keep things moving pretty quickly. And, potentially you could sell all of your assets all at once on the upturn,
Yeah. Always be ready for it. And then, it kind of takes us back to that acquisition stage. You're going back to that pro forma, seeing what you initially wrote the exit price at.
And then just have a spreadsheet available for brokers to look at. And as we get closer to those sale prices, then, have those be an opportunity.
Yeah. And speaking of brokers, because there's individuals, across the market here, getting introduced to brokers or meeting folks within the market, how does it typically work in terms of choosing a broker for a deal?
Well, for us, we are brokers ourselves, but the multifamily marketplace here in Portland is very closed. It's not something that a broker could break into, like an outside broker. You've got to spend, years developing relationships with property owners and for us, since we're buyers, we really value those relationships with those brokers. So of the people who are doing the most sales volume, we want to be choosing them to sell our deals, but also we want to spread it around a little bit.
Mm-hmm.
And then as well, we also promise if somebody gives us a deal, if we buy them a deal, we're going to use them on the exit side. Yeah. So on the stuff that we purchase, that we either find ourselves off market or broker ourselves on the RMLS, that we kind of have those options open. I believe that we're going to list a couple of those on the RMLS. We tried to do that with Southwest 68, but unfortunately we didn't get a buyer for it. And so then we used one of our, I guess, basically the broker that we've used the most, to kind of reward him for giving us so many deals.
Cool.
So yeah, with Huber, we have it listed with the broker who sold us the deal.
Yeah.
And
nice.
Then with Southwest King, that is something that's on the RMLS. We've had a handful of people give us price opinions on it. Probably going to list it on the RMLS. See if we can get somebody who is interested in it. Mm-hmm. If not, then we will choose a broker to list it for us.
Sweet. Thanks for the details there. Yeah, I'm look at residential all the time, but the multifamily market I know has kind of a different kind of space in terms of that broker.
Yeah. I mean, residential is a little bit more of a commodity.
Yeah.
Where I would say commercial real estate is a little bit more of a relationship business. Mm-hmm. And, it's not like you're just buying and trading on eBay. It's more of I don't know, what's a good analogy for it? I do feel like residential is just, the market's pretty easy to break into. Maybe some neighborhoods are harder than others because there's really experienced people in them, but you could potentially just break into it.
Yeah. I mean, maybe an analogy is the stock market, because the numbers have to work as well, right? And a little bit, we talk about NOI and that hitting being at the right space for the numbers to work, for it to justify the sales price. Right?
I'm just talking about more of a closed system. Where there's high barriers to entry. I'm talking for a outside broker.
Yeah, okay.
Somebody who isn't coming in with either a national brokerage with a ton of resources to try and steal business from the other brokers, or a company like ours where we aren't multifamily brokers. And, to be able to buy multifamily real estate in Portland, we need to be able to transact with the people or the brokers who are getting most of the deal flow. Yeah. And so to do that, we essentially have to play nice and guarantee, that we're going to be a relationship for these other brokers, because basically they won't sell us a deal. And I've had times where we've been the best offer, but we don't get the deal. And that's a rough one.
Yeah, that's tough.
That has probably happened to us 10 times.
Oh,
And, part of it is, and it's just a very hard market to break into. Like, I mean, if you look on our Stark deal, we weren't the best offer, but we still got it. So, that actually feels really good after putting in the experience. So yeah, I don't have a good analogy of like, I do kind of feel like the residential market is like eBay. You just buy and sell.
Yeah.
Like it's just, and there's a commission, and essentially like all you have to do is pay the fees and you're in the market, wheeling and dealing.
Yeah.
And, multifamily and commercial is just very different. Like there's gatekeepers and high barriers to entry.
Yes.
So
still getting the rundown on how that all works. But let's talk about getting to disposition. What gets an asset ready for disposition in terms of, financials and operations? Maybe I'll talk about the operations piece, because that's
something we've been focusing on.
Something we've been focusing on, and we talked about the Southwest King opportunity. There's a space where curb appeal is a thing, obviously.
I mean, there's, you like, whether it's you're leasing a unit or, you're trying to sell an asset to an investor, the first impression matters a lot. So what do the photos look like when somebody sees them? And then also, the investor is looking at financials. Like what do the financials look like? And a lot of times an investor is going to see, like with our deals, is that we've already kind of taken the low-hanging fruit out of the investment, and it's operating pretty well. And so essentially somebody who's going to be buying that, they're buying a pretty like well-running asset. And that is a little like, most of the times an investor is going to want to see like upside. And especially, and if there's not as much upside, most of the units have been remodeled. There's a thing called rent premium. It's what, rents are currently at. And then if you, do some value add, what's the premium that you could get, kind of like a high watermark for leases that have been signed. So, people are looking at rent premium a lot to see, okay, like if we, do a little value add here and upgrade the property, what can we get out of it? But yeah, in terms of operations, like we're trying to limit our CapEx cost because we don't want to be investing a ton of CapEx. I mean, obviously we want the asset to be, running as best it possibly can. And then if there's CapEx items, then I really feel like, okay, we should note those CapEx items, let the new buyer know that, hey, there's value add opportunity here and there's rent premium to be garnered. So yeah. And honestly, when I said the first impression, like, having a property that doesn't look perfect, because then you can sell that upside story. It's like, hey, do paint, do some landscaping, like, and we're able to get it operating at this level in its current condition, and with a little bit of paint and new property management company, maybe some signage, like it's possible to juice it up a little bit better. Yeah.
And now here's a word from our sponsor.
Get things done while you're on the move. Learn more about working with a virtual assistant through Offsite Professionals. It's a great way to get all the things done that you need to get done, have freedom in your time, and streamline your life by automating your business. Stop spending time on the tasks that you can delegate and start spending more time on your superpower. Call us today at 503-446-3177 or visit our website at offsiteprofessionals.com.
Uptown Syndication is now offering a syndication coaching program for you to take your real estate portfolio to the next level. This is your opportunity to have experienced syndicators, AJ and Chris SHEPARD, coach you on your way to controlling your real estate investing future. Our coaching program will provide you with the tools and framework needed to begin syndicating real estate in your target market. Go to uptownsyndication.com today to learn more.
Hey, let me ask you, what if tax season was actually exciting? I know, it sounds crazy, but not when you've got the right playbook. At mymoneyworksforme.com, we put together the Pro Tax Strategies playbook that real estate professionals use that you may not know about. You'll learn how to crush taxes with depreciation and rep status, how to stack smart write-offs from the Augusta rule to vehicles, and the ultimate wealth hack, 1031 exchanges and vacation rentals. It's free, it's powerful, and it's waiting for you at mymoneyworksforme.com, because your money should work as hard as you do.
Yeah, but in terms of property, I think, in operations side, that we talked about curb appeal a little bit, but just I think landscaping is an aspect which, the first thing you see is landscaping.
Can you see the curb?
Yeah, can you see the curb?
If you cannot see the curb, then how is it supposed to be appealing?
Yeah, because it takes getting past the curb to get into the property, 100%. But whether we're taking those preventative maintenance pieces along the way and supporting the property, I think allows people to get to the doors and inside and want to go check out the units and maybe take a little deeper look at the financials, which the financials are very important, right? And we kind of talked about that in a previous episode a little bit, but in terms of financials and like that being a part of it, for getting to disposition, we're based on the pro forma, what are some cap rates that we take a look at?
Yeah, that's exactly what was going into my brain is we have to talk about cap rates.
We do.
Here we are. What are cap rates? What is a cap rate?
The cap rate, oh my gosh.
It's net operating income
over
divided by cap rate equals price.
Yes.
So it's price or net operating income divided by price
equals the cap rate. Yes.
Yep.
Apologies there. Put on the spot. And
it's kind of like a simple equation. E equals mc squared, or force equals mass and acceleration. So you just got to do a little algebra and you got it. But the problem with that all is what net operating income are you talking about? That's a big deal. There are probably 12 different net operating incomes when it comes to looking at an asset for sale. You've got the actual numbers. Mm-hmm. You have scheduled rent numbers. You have pro forma numbers. You have the numbers that the bank is going to look at. And then you've got your pro forma numbers. So maybe not 12, but it's about five or six. And so, each of those net operating income numbers comes with a different cap rate. The worst, unless the market is declining severely, if everything's flat or, most of the time, the worst is going to be the actuals in terms of how the property has been operating, unless it got juiced up by a lot of concessions a year ago and they found good tenants who just wanted good concessions and they're a year into that, the lowest revenue should be a year ago because rents have slightly increased in the past year and expenses have also, are the highest that they've been for a little while. So looking at that, so scheduled rents for this month should be higher than the average of the last 12 months. And so scheduled rents, that's another way to look at it. That's generally how the bank is going to look at it, but they will also put some overlays on what they think expenses should be. The bank numbers are, I would say, slightly more optimistic than actuals or the schedule. Well, yeah. I guess there's a sixth one in there.
Okay.
Which is going to be basically what the real estate broker puts in their advertisement.
Marketing, yep.
Because that is, they will use a mix of like actuals and these are market averages and, this is what you should expect in the city of Portland.
Mm-hmm.
And yeah. So, I mean, there are just so many different cap rates to look at. And so I would say that cap rates the ones that only matter are the actuals, at least for me, are the actuals, and then what the bank wants, and then what you actually think you can do. And so what you actually think you can do is what I call the pro forma cap rate. Oh, and there's a seventh one. It's after your value add. What do you think the cap rate's going to be after your value add?
Mm-hmm.
And so, yeah, like knowing what is going into the net operating income number is essential to being able to underwrite the deal, and also essential to being able to sell the deal.
That was a lot. It was more than I thought, to be honest.
Yeah.
And again, still getting up to speed on
cap rates are it's just a moving target. I don't think it's the best way to look at a deal. I honestly think that a price per door,
mm-hmm.
Knowing what, being able to like add or subtract based on location,
amenities,
based on washer dryer in unit or not, 1 bedroom, 2 bedroom, 3 bedroom, unit size, and just kind of being able to like keep in your head like, okay, we got 900 square foot with washer dryer. That's going to command a little bit higher than a 650 square foot 2 bedroom without washer dryer, and then you can adjust for location. Like if one is just prime location and then the other is way deep in suburbia, you make your adjustments.
Mm-hmm.
And so I honestly think that that's the best way to arrive at a price, and then just knowing what you're willing to pay for something that's operating quite well versus something that, is not operating well, but you think that you can add value to it.
Mm-hmm. Yeah. So there's pieces outside the numbers too. An example, like I know to look at a deal and you underwrote the deal. And then once we saw it, there were some things that kind of led some questions like, hey, what would market rents actually look like based on this property and the amenities offered? It caused us to look at it a little bit differently.
Yeah, and walk from the deal.
Yeah. Yeah, because I
don't think that one's sold yet.
Yeah. And that was under contract initially on it. So sometimes you get back to the acquisition stage when you take a look at the numbers, get into it, and then you kind of change your mind. So that occurs. But talking about timing, we obviously have a plan for deals. You talked about the 3 to 5 year kind of hold period that's advertised. But sometimes, things pop up and maybe the timing is right. So as we think of the future and disposition of deals, how do we balance timing of exiting versus, the planned pro forma, the event where we, target hold period? How do we adjust accordingly?
Yeah. Well, I would say part of it is the returns we're trying to achieve. Yep. So, having those strike prices, or I guess not strike prices, but like targets for our sale price, and just having those out there. And then after we've kind of hit our time frame, if we haven't hit those targets yet, then, I think that we want to look at selling at a lower price and, accepting the fact that, hey, that one might not have been the best deal that we've ever done. And that's okay.
Yeah.
You're not all going to be home runs.
Yeah. Sometimes weird things happen within the market, which
or maybe sometimes your analysis on a property or an area was incorrect, and
or changed based on the local economics or larger, macroeconomic factors. So interesting. Talking about once we close on that, how do you walk investors through the waterfall and how they're getting paid, or what does that typically look like once we?
There's a good question. This
is
something that we're not experts at. We've only done it once. The waterfall is based on an internal rate of return. And the internal rate of return is a way to calculate annual continuously compounded returns based on the time value of money. And I mean, essentially the way that we have Excel and we're using the IRR calculator, but we take all of the cash flows that have come in each quarter, assign a date to them, and then we're plugging in the projected net cash flow from the sale on that future date, and then trying to figure out what the IRR is. And I mean, essentially the way that our waterfall works, and we explain this prior to acquiring a deal and before anybody signs up, it's in all the operating agreements, but Uptown Syndication is a general partner, and then our investors are limited partners. So limited partners receive 100% of returns up to 7%. And so essentially Uptown Syndication is general partner, is not taking any, it's called promote, or any percentage from that area. And so from 0 to 7% is like, we don't want to take anything out of the deal if our investors aren't making 7%. From 7% to, and this number varies based on the deal. I want to say it's probably somewhere around 15% IRR. Some are a little higher, just depending on the deal. That is an 80-20 split. And then basically if we hit a home run and we've held a property for, I mean, basically we're looking at least 5 years holds for all of our deals right now. So earning 15+% per year is not a bad return,
Really good, actually.
But I think it actually would beat the stock market if we were returning that right now. I mean, the stock market has been on fire for I think the last 3 years are 20+%. But 2022 was not. 2022 was a down year, and 2021 was nice, but essentially 15% every year, I think, rivals that. And so the deal that we did do and sold last year at 68, rivaled the stock market, which I feel like is pretty good. But above 15% is a 50-50 split with general partners and our limited partners. And so that's the waterfall. Yeah.
Yeah. And I know typically in the beginning we do webinars. Curious, do we typically do like a completed deal webinar? I know we have a, speak to the track record.
We did not do a completed deal webinar for 68.
I think we should do that for next.
Yeah, definitely for the next one. I mean, the problem is with 68, we put it up for sale in 2023 and it closed in like June of 2025. And so when do you do the completed sale webinar?
Yeah.
I mean, obviously we do it in June.
Yeah.
But I think we had sent out maybe 15 or 20 updates because we were in contract, and then we were out of contract, and then we were in contract, and then we were out of contract, in contract, out of contract. I think that happened 5 times.
Yeah.
And so like at that point, I was just like, okay, if we accept an offer, we're not gonna, tell anyone until they've made it through the due diligence period.
Yeah.
And yeah.
That makes sense. And that kind of led to the next final question I had was around like, based on that last deal, anything to do differently? It sounds like that. I bet when you got that first offer was so excited.
Oh, it was above asking price and we were stoked.
Yeah.
And then like kind of the market started getting worse and then they ended up dropping out. We were super bummed because we were going to have huge returns for, but yeah, anyway, it was fine.
Yeah.
You know, like this is an area where the acceleration, like we're gonna, like, I feel like if we do publish our strike prices for our deals and get them out to brokers, you know, I think that is an opportunity for us. They can look at our deals and kind of pick and choose which ones they think will be good buys or not.
I mean, it's interesting in some of the areas, like seeing a lot of growth out in near a Cornelius property, and like really impressed with that area of Oregon and how it's growing very quickly. And I'm like, wow, there's a lot going on here. A lot of investment is going on here. And so, you know, they've worked through some challenges in the value add deal there, but I'm like, wow, I think this is going to turn out to be a great deal.
So one of the difficulties too is, you know, in calculating our exits, I guess just with the way the market has been going, some of the deals that we entered into, we projected higher or lower expenses. And so if the expenses are higher, the net income is a little bit lower. And then, you know, we actually are ending up paying less of a preferred return. So there's a larger preferred return accrual based on that exit price. But I mean, in the end, you know, like we underwrote that exit price probably based on a higher NOI than what we're actually getting. And so if we're not paying the preferred returns, we probably need to lower those target prices just because the net income's lower.
Yeah.
And then, you know, also the deals that we bought in 2021, 2022, 2023 even, you know, we bought those off of much lower cap rates, like, and we projected sale prices off of. So the way that we underwrite is we underwrite cap rates are going to be a half point higher. So like if we bought something at a 5% cap rate, we would project a 5.5% rate cap rate exit. But unfortunately, cap rates have gone up probably 1.25 points. And so that's another thing to look at just when we're swagging our exits.
Yeah. So a couple of deals we have available for sale, you know, getting ready for sale.
We have one that is on the market.
Yes.
We have one more that we are in process of prepping for being on the market.
Yeah. And continual learning. And I think, you speak to some things on potentially what we can do differently as we get to the disposition of these newer assets, getting ready for sale or that have been ready for sale. And I think, we'll have to take a look at adjustments, and then that leads into future deals as well and how we underwrite maybe differently as, you know, things change over time.
Yeah. And I mean, with the changes in the market, you know, it's harder to make a deal pencil right now if we project a half point increase in cap rates because they've so like violently, like since the cap rate expansion has been so volatile, it's tough because a lot of, like, you know, I would say 2 years ago we were at 4.5% cap rates, and there's still a lot of sellers who are like kind of anchored in right there. And you know, now we're like probably a little closer to 6. And so to buy something at a 6 and then project that we're going to exit at 6.5, when we're barely able to get a seller to sell, and it just makes it tough. Yeah. But I guess as, the cap, like where we're at, and then where sellers are anchored, as they kind of like converge a little bit, that is going to make it a little easier to transact. And so like I would say that is one of the issues of why it's so difficult to sell a deal right now, is that the volatility of the cap rates. And the expansion of cap rates.
Yeah, and the numbers penciling. It doesn't necessarily work. Well, great. Well, thank you, Chris, for sharing some details on disposition. Continual nuggets come from each of these conversations, and hopefully the listeners have them as well. Any other final thoughts to share?
I mean, I guess in closing, deals have to transact.
Yeah.
And so we're getting into that period where there is going to be more transactions done. And that's, some transactions beget more transactions because of 1031 exchanges, and then the deal flow is going to accelerate. And, I would say last cycle, once we reached that point of where deals started to have to transact, prices actually went down. And so I think we're still in a buying opportunity. It's going to be hard to sell until we can kind of like dig our way out of this buying opportunity. And then the people who buy well below the market will want to sell when we get back up to where the market was, last year, or actually like 2 or 3 years ago. So, yeah. Buyers and sellers need to converge. We'll see what happens. Hopefully it's soon. It's going to have to be the sellers willing to transact at lower prices for the moment. Okay. Well, thank you all. Take care. Bye-bye.
Thank you for listening to this episode of the Real Estate Professionals Investing Podcast on WIN, your community of investing knowledge for growth. We hope that this episode has increased your knowledge and added value to your path to freedom. If you would, please take a second to rate us so that we can get more great investors to interview. If you or someone that you know wants to be on, please visit westsideinvestors.com and fill out our form to be on the show. Thank you again, and enjoy your day.